Expired. With that, we go to the gentleman from Texas, Mr. Green, who's recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Ranking Member. Thank the witnesses for appearing. The markets in terms of how they impact affordability. And more specifically, the residual market juxtaposed to the voluntary market. For our purposes, I think it's fair to say that the residual market is the market of last resort. The voluntary market is a competitive market. And the way we structure the residual market is going to have a lot to do with affordability. So I'd like Mr. Ellis to visit with you because I've read your testimony in its entirety, and the last paragraph of it, where you give your conclusion, I think is quite revealing. You indicate that the federal government will develop the residual market. How will that market be developed such that we will still have competition in the voluntary market and not have the taxpayers assume all of the high-risk persons that the voluntary competitive market does not find beneficial in the sense of profits and loss market demands? And I mention this to you because, as you know, with the health insurance, we find ourselves with insurance companies assuming a lot of clients, if you will, who are not over age 62 to 65. When you get above that, the insurance companies are not enthralled with the notion of having you as a client, customer. And given that I'm above that age, I kind of look into these things, as you can well understand. And I see you smiling, so you understand what I'm talking about. So what I'm interested in is finding out, how do we have a residual market that will have a positive impact on affordability, given that the voluntary market is where everybody wants to be, and getting insurance companies to go residual can be exceedingly difficult?
Thank you very much, Congressman Green, for the question. Part of what we were observing, and was actually observed in the reports that came out after Biggert Waters, the FEMA reports that came out, is that the residual market is where it is actually going. Unintentionally or intentionally, that is what is developing as the rates increase in the flood insurance program and as competition is going to come in. And so our point has been that it needs to be, and I think you're spot on, Congressman, is that it needs to be an intentional decision by Congress on how to develop that and how to protect those consumers. Also, as it becomes a more concentrated market, then it's become something where Congress and the executive branch can target mitigation to help those people out. So it's not just about affordability because we're giving them subsidies or we're giving them a cheaper product, but we're actually reducing their risk so that there becomes an appetite in the private sector to write policies for them as well. Because unlike your example in the health care, which I'm not an expert in that area at all, but it isn't that there is a 60-year-old house. It's not that houses get to being over 60. I mean, not obviously there are houses that are 100-year-old, but I mean that same characteristic isn't analogous. We can actually make that 60-year-old house, at least in a risk standpoint, be a 30-year-old house if we do the right mitigation tactics.
Given that I have about a minute and 18 seconds left, permit me to ask this. Help me to flesh it out. Help me to understand, and others who are listening at home to understand, what you would do specifically to make sure that the residual market is affordable for persons who are going to live along the Gulf Coast. I'm from Texas. I went through Katrina, Rita, and those who are on the East Coast where we had Sandy. How do they have affordability? Give me some examples of how it can be done.
Well, there's one of the things that came out of Wharton was this idea of vouchers to help people purchase their insurance. But I also think, and I know I'm kind of going back to this, I think we should be trying to mitigate their risk and providing them assistance to mitigate their risk to reduce their rate rather than just giving them subsidies. But we already have certain affordability provisions built into flood insurance with the pre-firm structures that have explicitly grandfathered and subsidized rates.
And by mitigation, you mean cost to replace or repair?
Well, no, not to repair or replace. Well, it could be to relocate, but it also could be, to elevate or other mitigation tactics. I mean, I think that what we want to do is reduce the risk. It was brought up earlier that, for every dollar we spend on mitigation, it's $4 less in disaster costs, and we think that would be the way to target it.
Thank you, Mr. Chairman. I yield back.
Gentleman's time has expired.